So now I get to introduce our first speaker. His name is Caleb Callahan. He's a shareholder and president of Valmark Financial Group. He's also chairman of the Valmark Global Gift Fund. His past speaking engagements include the American Bar Association, the $1 Million Roundtable, AALU. He's also testified on behalf of our profession in front of the National Association of Insurance Commissioners, the Department of Labor, and even to the United States Congress. Caleb is a certified financial professional, is a graduate of the University of Akron with degrees in both finance and economics, and he's also pursued executive training at both Harvard Business School and MIT's Sloan School of Management. Today, Caleb is going to talk to us about the future of the investment business. Please join me in welcoming Caleb Callahan. Caleb?
The title of my presentation is Investing in the Future. And you'll notice I ended it with a question mark. This is a lot less of investing in the future. I know what it's going to be, and I'm going to tell you how it is. This is more investing in the future. Like, I wonder how this is going to work out. And this is as much about me asking you questions as it is me giving you answers. So I've got some data that I'm going to share with you. I'm going to recap some of what I shared last year. And then I've got a formula that I think makes sense, but it's really going to be up to you to evaluate and see if the jacket fits for your business. I will say you have to be careful, though, anytime you talk about the future, it's difficult. And Larry's got all of his wisdom from the sages and the philosophers. It's Winston Churchill, it's Marcus Aurelius. My go-to philosopher is Yogi Berra. And Yogi says, it's tough to make predictions, especially about the future. And I gotta agree with him. It is much easier to make predictions about the past. In fact, if I were here last year and I could redo it, given the 2020 that we had, here is what I would tell you to do. I would say, you need to go long in Purell. Buy it everywhere you can. Buy it at CVS, buy it at Walgreens, whatever you do, you go long. Number two, you need to dust off that sewing machine your mother-in-law bought you for your wedding, and you need to start embroidering masks. This is my favorite mask, 2020, 1 star, very bad, would not recommend. And I also would go long in commercial real estate, and you think like, well, why would you do that? Isn't work from home a thing? Our lease is gonna go down, our property value is gonna go down, and I would say maybe, except in one area, and that is the bricks and mortar state liquor agencies. I would go long in that, and you want to talk about multipliers. Bobby Samuel talked about this yesterday. Imagine if you open the state liquor agency, you're doing that in the storefront. In the back, you're taking the old alcohol. Guess what you're doing? You're making the Purell. You're making the Purell. You talk about wrapping that up. You put that in an IUL policy, and I think you're really talking at 12 to 14% rate of return. So that would be my advice if I was here last year. In terms of what we're going to talk about today, I always tell you that I don't have a lot of original ideas. The truth is that I read a lot, I ask a lot of questions. If you ever hear me say anything that sounds semi-intelligent, I've borrowed that from someone else. So last year I mentioned we're a member of the Tiburon Strategic Advisor Group. It's a study group of the elite presidents and CEOs of the organizations that you see on the screen. And so I want to give them credit. A lot of what I will share today and a lot of the questions that I'll ask stems from my reading and understanding of their view on the markets. So let me begin where I left off last year, and that is 4 trends that are impacting advisors. And we talked about this last year, and I want to recap what I believe are 4 major questions that are looking at you if you're in the investment space and saying, how are you going to respond to each of these things? So the first is the wealth shift to millennials. The second is the emergence of retirement crisis. The third is to understand about technology and are the robots going to take over. And the fourth is where I really want to spend the vast majority of our time today, and that is on fee compression and value creation. So let's dive in. The wealth shift to millennials is, I think, pretty straightforward. The data is compelling. Millennials and both Gen Z are growing rapidly. If you look at the households, number of households over the next, we're about 30% through the decade of this chart, you can see that the number of households will be by 2027 over 50 million of roughly 100 million households. So you're talking almost, give or take, 35 to 50% of all the households in the United States are going to be millennials. Thank you. The other thing that's compelling is the savings rates. The savings rates are, millennials save money much faster in terms of their investable assets. They're making good money, they're living at home. It is likely that they will accumulate assets to invest at a rate of 20% a year. You compare that to any of the other major demographics, and it is true. Millennial households are growing quickly, millennials are gaining a lot of assets, and at an annual growth rate of almost 21% a year, it's reasonable to expect that there will be a lot of money in that market. But the truth is that even when we get out to 2027, there's just still not a lot of money. You're talking about $10 trillion of almost a $100 trillion investment asset pie, so maybe 10%. So my point on this, and I'm moving quickly to recap, is don't buy the hype. I would say don't reinvent your business model to go after the millennial market. What I would say, if you have a young professional in your office that you're looking to carve out a niche, this would be a good space, but this would not be a game-changing, strategy-shifting, business model evolving moment for you. Let's talk about the looming retirement crisis. We created Risk actually 10 years ago this year. 2010, 2011, we launched the Risk process, and it was all about helping people transition from accumulating assets for retirement to distributing those assets in retirement. And we talked about the crisis that is created in that space. Now we look back 10 years later, and we've had a really strong run in the markets. And I would tell you that investable assets among retirees is at an all-time high. But we don't just look at investable assets. When you talk about what are assets in play, it's the total of all financial assets, including retirement plans, including personal assets, including small businesses, and there you get to the total amount of financial assets. And when you add all of these together in the marketplace, what you end up with is not just the $50 trillion that we typically think of assets in separately managed accounts and assets in play, but it's actually $126 trillion, an additional $76 trillion that is primarily being created by personal assets outside of the financial portfolio. Not only retirement plans, not only typical SMA accounts, but an emerging personal assets, and particularly small business valuations, which have done incredibly well over the last decade. So I will tell you, and we'll come back to this, about carving out a niche in the financial market, looking at the emergence of the small business over the last decade, and not only the valuation of those, but the planning needs of the small business, I think is an incredible opportunity. And so I would say that this is much more of an opportunity than a retirement crisis. And the reason I think it's an opportunity is not just the $76 trillion that's going to be in play, transitioning out of personal assets and small businesses into more of a retirement phase, but I think it's an opportunity specifically because of the unique value that you can add as financial professionals. In 2010, we created the Risk process, and the whole concept of Risk is very simple. In fact, it was so simple that we stopped doing it, and I go back and think this is still one of the most compelling pieces when it talks to value creation for clients, and that is this. You're used to investment allocations, right? We talk about this all the time. People are used to seeing this in their 401k. They're used to seeing this in virtually every form of financial communication that they see. And we help create the mental shift from an investment allocation to an income allocation. And certainly that there's asset allocation as a part of that, but there is also a variety of other holdings that are unique for the distribution phase, the transition phase of wealth creation, than just pure asset management. And so this diagram to me of diversifying between asset management and equity income guarantees and longevity insurance and tax-free death benefits is truly value creation. And it is unique to what you can offer at Valmark as what we call a three-circle firm, being in the RIA business fee only, being in the broker-dealer space when you need a commission solution, because most of the mortality-based solutions still pay commissions, and being in the insurance business. That is still something that the largest RIAs, even at Tiburon, I don't care who they are, Focus Financial, Edelman Financial Engines, Hightower, they want to figure out how to get into the three-circle space. I've been asked to speak in Manhattan in March to help large RIAs figure out how they can offer broker-dealer and life insurance solutions, because they recognize that fee only is not possible to deliver best-in-class solutions. So I would say that the retirement crisis is not a crisis, it's an opportunity, especially for three-circle firms at Valmark. Let's quickly talk about the rise of the machines, right? We all hear about robo-advice. We all wonder if this is the future of our industry and we're all gonna be working for artificial intelligence just like the sci-fi movies. And the data is compelling in terms of at least looking back over the last 11 years, that the amount of assets, you're talking about $500 billion are in true online advice platforms. This is not a small amount of money. This is a substantial trend in our business. But when you take this data, and the devil is always in the details, and you break this down, what you come to see is that the vast majority of that online robo experience is with large retirement platforms like Schwab, like Fidelity, where it's less about the technology and more about the platform of being a dominant player in the defined contribution space with just a really good user interface. The truth is only about 10% of that $500 billion right now is with what we traditionally think of as robo-advisors. And so at the end of the day, what I would say to you on this trend or this question of are the machines gonna take over, I would say that's really up to you. I would say I see it much more as a tool than a threat. And as Ron Ware talked yesterday, I think there's an opportunity for us to embrace a lot of this technology where it shouldn't be an either and choice. It should be a both and choice. I should be able to get the expertise of Joe Manning while still getting the technological experience of the best user interface on the market. And so that's what we've spent a lot of time investing in at Valmark over the past 3 years, and I'm gonna talk to you about that a little later when we get into value creation. The last question that's kind of a review from last year is this idea of fee compression. And there are two major schools of thought on this. There is the idea that fee compression is happening and it's here and it's moving quickly, and we have to quickly figure out a way to pivot because we've made a lot of money for a long time in the fee space. The other school of thought is, no, look, this is every business goes through this. I'm adding more value than I've ever added. In fact, springs like the spring of 2020 just showcase how much value I create by being there for my client. If anything, the value of advice has gone up, right? Those are primarily the two schools of thought when it comes to fee compression. And I will tell you this, I'm not gonna try to debunk either one of those arguments, but I tell you, I'm a reader, I'm an observer, I ask a lot of questions. McKinsey and Company put out a report earlier this year, and they looked at the return on equity of major segments of key services in the United States. And you can see from the graph that by far and away, especially when you compare to some of the larger financial institutions like the banks or like the insurance companies, the ROE expectations for wealth management firms are still off the charts. You're talking 20 to 25% ROE. These aren't just projections, these are actual calculations by McKinsey and Company looking at the fee-based wealth management business. Look, I can't tell you that that's gonna change in a day. I can't tell you it's gonna change in a decade. But what we do know about markets is nobody stays at the top forever. And you can talk about your niche and what it's like in your community, and you might be insulated from this longer than others, but you can't have sustainable 25% rate of return on equity investments without pressure. And we've already begun to see that because the valuations are crazy. Those of you who have contemplated retirement or had any type of business valuations on possible purchases, you know that what firms are offering to pay for asset management business is a lot of money. Well, what's the other side of that? They want to make money on that money. There's going to be cutthroat competition. I think there will be at some point more fee pressure than we experience. Maybe not today in the midst of a crisis, but certainly at a macro level when you look at the data. The other thing that McKinsey & Company did is they looked at what is the pre-tax operating margin of these businesses. And you look at this data, and it's the same thing. It is a business where you can make almost 40 cents on every dollar that you make in revenue, that 40 cents comes in as profit to the bottom line. Now, some of you are different. Some of you that may be like 20%, some of you that may be 80%. I mentioned Joe Manning, the joke with his former partner, Jim Yearman, was his gross is his net. And you work out of your car and bring everything with you in a briefcase, you can have a 99% operating profit margin. The point is, it's likely not sustainable over the long term. 35%, it's a great business, and we have no intention of changing it or getting out of it. In fact, Michael McClary talks about this a lot. He says, that takes a really long time to unwind. You can have pressure and you can have changes, and billions of dollars still makes a lot of money for a very long time, and I agree. And it's still something that I'm extremely bullish on. In fact, Larry really enjoys and loves, I'm sure you've seen, he's passionate about the insurance business. I tend to gravitate a little bit more towards the investment business and making sure that we stay balanced as an organization. So I have every intention of continuing our investment and success within our RIA and broker-dealer, which frankly over the last decade has been together more profitable than the insurance business. So we're committed to both space, but I'm just being realistic with you about what the future will likely hold given the data, not sustainable over a long period of time. And when the CEOs of the group that I mentioned at Tiburon, so you're talking Walt Bettinger at Schwab, you're talking every major player within the super custodian space as well as within the super aggregated RIA space, was surveyed, and they said, do you see pricing pressure on fees? And the answer was that 83% of them said yes. Now, 53% of those said it's going to be moderate, and then 40% said it's going to be significant. But the difference is the change in year over year. You look over the last 3 years, and this is a pretty significant change from roughly 50% going all the way up to 83% on the number of CEOs recognizing that there's going to be fee compression. So what's the conclusion? The conclusion on this is, my personal hypothesis is this is a real threat. I think this is something that we have to talk about as an organization. And it goes back to what I said about the golden rule, me coming down here 15 years ago, having no clue what I was doing, and people put their arm around me and said, hey, we're going to help you figure this thing out together. To me, that is what the opportunity is for the evolution of the financial services firm. It's meetings like this. So I would just encourage you for the second half of this presentation that you would not zero in and say, I disagree completely. I don't think fee compression is going to happen. I think we got a great business and nobody can touch us. That may be true, but it's just a matter of time before it begins to impact. And I think that by putting our heads together, we can come up with some pretty unique value creating models. And the quote on this, I love Michael Kitcey's. Many people read any of Michael Kitcey's work in the room. Okay, so maybe about a third of you. He's got some good material. I don't agree with everything that he writes. He, like all of us, has a bias, and he tends to have a bias towards fee-based, or fee-only, not fee-based, and that bias has increased since he's become part owner of a fee-based asset manager, coincidentally enough. But he has a great quote, and he says, this is an evolution, this is not a revolution. And the difference between, obviously, a revolution and evolution is a revolution looks like people like Sam Adams showing up, running with a rifle and tossing tea into the harbor. An evolution looks more like change over a longer period of time. And I do agree with him on this, that this is going to happen, but I don't think it's going to happen in the next 6 months It may not even happen in a dramatic way over the next 6 years, but you're not gonna have that level of return on equity or profit margin in a sector that is substantially higher than any of its peer industries for an extended period of time. And like I said, I can't tell you if that's gonna be a year, can't tell you if that's gonna be a decade, but I would say don't be misled by the fact that you're having your best year ever, which we all are, by the fact that we don't need to do anything differently. So what's this compression gonna look like? I think it's gonna be compression on both ends. Everybody always talks about the fees, but I think it's as much the bottom-up pressure as it is the top-down pressure. The top-down pressure looks like we would expect. It's a crunch of our revenues. It's, oh, we have to reduce our fees because Charles Schwab has financial planning for $30, and they also are gonna go into expand a robo-advisor platform now with the purchase of TD Ameritrade, and they're gonna become direct competitors, and that's gonna drive down prices, right? That's a very realistic probability. I think the greater compression is gonna come from the bottom up, and that's gonna come from the fact that you are gonna be expected to deliver more services on what arguably will be the same or shrinking revenue, depending on how much of a competitive advantage you have in your market. And what does that look like? That looks like expanded services from a technology standpoint. I don't know about you, but we've been spending a significant amount of money in technology over the last 3 years. That had to come from somewhere. We've spent a significant amount of money in expanding services to help with staffing of member firms. Everything we talk about culture index, everything we talk about consulting and getting the right people on the bus and in the right seats, all of those things become more magnified when there is pressure and technology is accelerating that rate of change. And so I think the greater challenge, like I said, is less about your fees going down, which they will over time, some faster than others, but more about the expectation of what it is that you are going to need to deliver to your customers in order for them to consider baseline financial planning to be met. And we know this is true. It's overplayed, and I hate to even say it because it's so trite, but it is true. Every one of us right now has ordered something at this meeting from Amazon that showed up at our house while we were in the room the next day. And those things don't happen in a vacuum. It's not like, oh, that's just one segment of the industry, but we're financial advisors and no one can ever replace a human. I think there is absolutely truth to part of that, but it can absolutely reshape the expectations that people have of us as advisors. And the expectation is all about 3 things that always exist, which we'll talk about in a minute, which is speed, quality, and price. So we go back to the old maxim that we always talk about. Ron hit on this yesterday, and that price is only a concern in the absence of value, right? So value is really what's gonna take a good leader to come in and say, what are the things that I can choose to invest in, because I'm going to have to invest more money in my business, that are going to create enough value to either stabilize or ideally create the fees that you're charging, but more importantly, invest in offering the services that consumers are going to come and demand from the bottom up. So what are those value-creating decisions? Every one of your decisions in dollars is competing. It's economics, it's scarcity, it's how we cope with a limited number of resources and an unlimited number of wants. That's the primary job for you as a business owner. Yes, it's about prospecting, but it's also about managing cash. It's about making tough decisions on where you're gonna spend the money and saying, of every dollar I spend, is this gonna ideally keep me steady or increase my top line to avoid top-down compression, or is this gonna expand the services that are going to, in some ways, slow down or mitigate the bottom-up compression that is happening in the marketplace? So we talk about value. I shared this maybe 5 or 6 years ago. This is not mine. I borrowed this from a number of good marketing textbooks. It's the classic value trade-off triangle. And it's pretty simple. It says you can pick any one of these 2 things, but it's very difficult to pick 3. Now, some people would argue this triangle will have a demise soon because organizations like Amazon are actually doing things very quickly with good quality for a very reasonable price. But for the rest of us humans that are not growing at exponential rates, there is still a trade-off between these things. And so you can see it most clearly in things like the dining experience. If I said to you, actually, you want to get really fast food and you want it to be inexpensive, what's the quality likely going to be of that meal? This is not a trick question. Very poor. It will be very poor quality. Vice versa, if I said to you, I want to have really good quality food and I want to have actually good service and relatively speaking, an efficient experience where I'm delighted by the service that I receive, what is likely going to be true about the price? It's going to be high. It's going to be high. So as a business, we have to decide what are the things at our firm that we're going to anchor in, what plays to our strengths in each of these things. And I'd love to sit here and tell you that I know what those things are for each of you. I have maybe some ideas. I could be helpful if you share. One of the nice things about my seat is I get to talk to a lot of firms. Larry and I, with our board and executive team, do a lot of strategic planning. I think I can be helpful, but the truth is I can't tell you. I really have no idea where you're going to add your unique value. But I will say this. There was a study done by Vanguard just last year, and it is the most helpful study that I've seen on trying to quantify where you should differentiate and add value. That if you had an extra dollar to invest, where would you invest that dollar in order to keep revenues steady or ideally increase them, or to stave off the compression from the bottom up, which is an increased demand in your times and services. And if you look at this, Vanguard study basically said that there's about some studies say 4% alpha that's created, not as alpha as an alternative investment in a core satellite strategy with an active management sleeve. I'm talking about your alpha, the change that you bring to the portfolio and we bring to the portfolio as the financial advisor. And the reality is that piece, as they broke it down, said it's 3 to 4%. So arguably, as long as your fees are less than that, you should be adding value, but certainly it's not sustainable to think you're going to make all that money. The reality is we should take that apart and see, well, it's not just everything we do is worth 300 to 400 basis points. There are certain things that we do that are worth a lot more money than other things that we do. And I want to draw your attention to the center of the screen, and Vanguard's research says that half of the value you create as an advisor has to do with behavioral coaching. It doesn't have to do with your ability to manage portfolios. It doesn't have to do with your ability to create financial plans better than anyone else. It doesn't have how great you are at tax loss harvesting or your dollar cost averaging strategy or whether you rebalance annually or semi-annually or quarterly. It doesn't even have to do with how crafty you are at calculating the buckets and the withdrawals. Those things are valuable. I'm not belittling those things at all. I'm just talking about relative rate of return. If you have a finite amount of time and money to invest, what does the data tell you you should do? And the data says that you need to really focus on the behavioral coaching side of this business if you want to continue to have a chance to add value in a way that will keep your bottom line where it's at. So what does that look like? To me, that looks like questions like this. I would ask you to be honest. Don't give me the line of, oh yeah, we do that, we do that, we do that. This is as honest and objective as you can be. Is your value really built around coaching? And do your deliverables make that clear? Or is what the majority of you talk about, if I went to your website, would it all be about how great of an investment manager you are and how great your process is? Which are complementary. Again, these aren't exclusive decisions, mutually exclusive. These are both ands, but it's about prioritization. Do you charge for it? Or do your fees come from other things? At some point, we're going to have to stop saying, I'm really not just an asset manager. I do all of these other things, and it's actually the most valuable thing I do, but the way I get paid is all from this other thing that's not important. Like at some point, that just doesn't make sense, and somebody is going to move and begin to say, you know what, if this is true, then we need to begin charging for that. And I would say it's a lot easier to start charging for it when it's small and separate than it is some massive migration when you have to do it, when lots of other people are charging significant consulting or planning or coaching fees in a creative way, whether it's pieces of retainers, whether it's percentages of income, which is true in some markets of high earners, low net worth or whether it is AUM based but broken down and says this is for these services and this other piece is for those services. How can you increase your expertise in coaching? How can you get involved with things like Mitch Anthony? How can you spend money to sharpen your skill set in what the data says is the highest value creation activity you can do? And the last thing is, how can you expand your availability for coaching? So you have to increase your expertise, but you have to increase your expertise. And so my idea on that for you is, this is what I always hear: I need another me, right? That's the number one thing when I talk to member firms and I say, tell me what's your biggest challenge. And you say to me more often than not, I need another me. And look, I want to help you with that. We're launching a staffing solutions sleeve and service next year. It was going to be this year, but with the pandemic, we had to make some changes, and we had some staffing changes that we will look to do this in 21. So I'm all in. We need to do this. But that's not primarily going to be your winning strategy. That's a supplementary strategy for you. You know, the real value to get another you is to free up your time and have twice as much time of the real you, not create another you. I love the internship program. I came from an internship program. But the primary way that you're going to add value is to duplicate yourself. How do you duplicate yourself? You duplicate yourself, you can have value squared. Value times value, you times you. Well, how do you do that? I think it's by outsourcing. I think it's by taking advantage of the primary services, not just at Valmark. I'm going to make a pitch for Valmark because I think we're really good, and I'm obviously highly biased. But it doesn't have to be every area of these things you look to us. I'm saying you go through your business and you say, what are the things, whether it's wealth management, whether it's financial planning, whether it's reporting, whether it's the analysis you do on life insurance products or annuity products, whether it is the support that you bring in the closely held business space, whether it's the succession planning that you do. We're not perfect, but we've spent a lot of time investing in these services. And it is perfectly fine if you want to continue to do all of them, but just recognize that you're likely trading off 150 basis point activity for 25 to 50 basis point activity. Just know it doesn't make great financial sense, but it might be about control. It might be things other than money, which I totally get. But at least if you're looking at this logically, I would say to you, the most important way to create value is to double down on where you have the highest value creation, and that is you. And while we will do our best to help you grow versions of you, mini-me's, by far and away the best way is for you to actually just double your own time of yourself that you're spending in the highest ROI producing activities. And so 3 years ago, we talked about this with the RIA 5.0 strategy, that we were going to put in a lot of capital, which we did, that we were going to invest in technology expansion. I'm happy to report to you that in 2020, Valmark was recognized as the technology firm of the year in Northeast Ohio when the local tech boards saw what we had done in the financial service space with my case. And again, I tell people, this is the beginning. This is not the end. This is not like, aren't we great? Look what we just built. We're all done. This was a really, really good first lap. And people like Chris, like Judson, like Jess are doing an incredible job in fintech. We added more investment choices. We've created cost savings, and we've created a ton of operational streamlining. My point in saying that is not to brag. It's just to say we've supercharged our platforms for the privilege of doing the work that you could outsource to us that is lower margin, so you can focus on your higher margin activities. And so if you haven't checked out Wealth Solutions offering, I would say it's expanded tremendously. Almost every time, I'm talking about firms who have been with us for over a decade, and they say, I wish there were more investment choices. And I say, well, can I walk you through? I mean, what do you want to do? Do you want to invest this yourself? Do you want to tell us what to do? Do you want us to figure it out for you? I mean, you literally pick on the spectrum the role that you want to have, and we can build it for you. So I don't care if it's ETFs, if it's mutual funds, if it's passive, if it's active, if it's stocks, if it's bonds, if it's hedged buffers, if it's insurance wrapped, if it's non-insurance wrapped, if it's fees, if it's commissions. The reality is I can't promise you that we're going to have an answer for every possible scenario, but I would say if we don't, you're probably spending too much time focusing on the wrong activity. I mean, just being candid with you, you're probably spending more time on a low ROI producing action than actually outsourcing what might be 80 or 90% of what you think it needs to be, but it frees you up to get to the 150 basis point activity of being a coach and having more time to see the clients. right? These cars, I always tell people, what's the best? And I can't tell you, these cars are all headed basically the same direction. I mean, let's not pay a lot of taxes, let's reduce our fees. But these cars are pretty much going the same way. I would not spend a disproportionate amount of time fine-tuning the optimal investment strategy. It's really, the data says it's not a good ROI. Last two things, this is a bit of a tangent, but I'll just put in a plug for you based on an Eaton Vance report that just came out less than about a year ago. And they've found that what we always thought has held true, that the pain of a loss is 3 times more powerful than the joy of a gain. And so all I would say to you is that as you're thinking about outsourcing and thinking about where you want to add value in your investment portfolio strategies, I would say it is still at the end of the day about volatility management. It is still at the end of the day about less about taxes, which almost all our presentations talk about, and less about growth and rate of return, a little bit more about income creation. But when they surveyed clients consistently for the past 5 years, the only thing that has not been volatile is the answer that volatility is the number one concern. And so I would say as you're looking to outsource things like this is where, as Bobby talked about, structured products can come into play. This is where what Finnefrock and McClary talk about with some of the solutions we're bringing in an ETF that will be live by the first of the year, before actually, but I'm hedging because I always am too early. But that's where you can add value, and you want to recreate those things on your own, or you want to outsource those things. It's hard for me to come to the conclusion that you would do all of that and recreate it based on the data. This is the most important thing if you're going to get into an activity. It's probably the one that will take you the most time to recreate, and it's one that you could outsource for a reasonable cost so you can focus on doubling your value in advisor. So what would I ask you about this? I would say, look, what are you going to outsource to create you times 2? You got to figure that out. I would say, are you a planner or an asset gatherer? And you got to be honest. I would say, are you capitalizing on your competitive advantage? If you are duly licensed as a broker-dealer, registered rep, and an investment advisor representative of an RIA, that is your competitive advantage. It might seem like you've been here so long that it's not popular anymore. I would tell you not to make the mistake of stopping doing what you've always done just because it's become old hat for you. This is exactly what the large RIAs are trying to figure out. I take these calls, I get these speaking engagements. It's how can we offer some of that? We're sitting holding, I think, the best hand, and the question is, are you taking advantage? I don't mean you need to have equal parts in all those businesses. That's not it at all. You might be predominantly insurance focused, but having the broker-dealer registration is what's going to help you to offer a path of the most innovative products, I think, in the insurance space. Or you might be predominantly fee-based, and insurance might be a very small fraction of what you do, but it's going to be 100% important the 5% of the time that you need it, and it will be differentiation to say, here's what the fee-only people, 0.5, can't do. And I think we need to go on offense more with that message. I think this is not about fees and non-fees. This is about both ands. This is about, sure, what do you need? I can wear all of those hats. And this is about going after and saying, do you know that these people, fee only, can't do this, can't do that? And we can help you with those messages. So here's my success formula for you. The first 2 pieces, there's 4 pieces to this. The last 2, I'll be brief. I think the firm of the future that is successful is a firm that outsources low margin activities, that takes advantage of your unique competitive offerings, namely 3 circles. That's what I'm going to call them. So I'm going to say U squared plus 3C. And there are 2 things I think you need to add to this. The first is you do have to figure out, though, who you are. This is like that Lion King moment when Simba's, that monkey, I can't remember his name. Who are you? Remember who you are. And I would say some of us have gotten lost along the way. I won't go into it, I don't have time, but those of you who have been here for a number of years know that I had some health challenges over the past couple of years. And when I look back on that time, I think that I had people who played very different roles in that process. I had the generalist, who is still one of my best friends, who returns my text every time I text him as my primary doctor and helped me navigate where I was going. But he was not the person who could really help me in the specific areas that I needed very high-end customized help. And I would say, just like in the medical profession, there are not right and wrong answers to this, but you do have to be honest about which one you are. And I would say I don't know which one's best for you, but I would just give you a couple points. Number one, my experience is that in the smaller markets, you're more of a generalist. That's true in any profession. I don't care if it's law, I don't care if it's medicine. There aren't resources available to really specialize. So if you're in a smaller community, you're in more of a rural area, you're probably more of a generalist, and it's probably a mistake to become too much of a specialist. Not necessarily, I'm just saying generally speaking. I think the opposite's true. If you're in larger markets, if you're in developed markets, I think it's a mistake to try to be a generalist. I think you should specialize. I personally think there's more money in specialization. My specialist costs me a lot more money than my general practitioner. And I think that when it comes time to regular medical diagnoses, I mean, you need to have your appendix out, you'll probably go to who your primary care recommends, right? You might even ask a family member, oh, you had your appendix out too? Yeah, I'm gonna have my appendix out, where should we go? But you get diagnosed with a rare condition that no one in your circle has ever heard of, I guarantee you that you're gonna be on the internet asking every highest network medical professional you know, who's the one or two people in the country that I need to talk to about this thing? And I would say the same thing is true in financial services. It's not wrong to be the guy or the gal who does the 401k and the 529 plans and everything else that comes with it. But I also think it's an even better idea if you can to say, I'm best in the world at this. I mean, generally, I'm the best, I believe I'm the best there is in the entire country at this. And so you could have someone do your 401k plan, but the truth is, what I'm really known for is this activity. And that might be more of helping closely held businesses and entrepreneurs sell their business, exit their business, helping investors find places to put capital to buy other business. There's a ton of opportunity, I think, to specialize in niche markets. And I would say if you don't know how to do that, there are people in this room who do. So I would ask you quickly, are you a generalist or a specialist? Does your current client list reflect this? A lot of people, it's like, I'm this, and I say, well, tell me about your clients. It's like, no, you're not. You want to be that, which is okay. You can evolve. Are you best in the world at anything? And how would I know this if that's true? When I Google you, what do I read about you? And how do you market and segment this message? Look, I'm not saying we're great at it. I aspire to do this more with Larry at Valmark, but I view us as a specialist firm. I don't see us as a broker-dealer for the masses. There's 400 people, 300 producing in the entire country at Valmark. That is not a generalist business model. That is independent business owners that life insurance is a key part of what they do in the financial services space. That's the segment. It doesn't mean that life insurance has to be the majority of what you do, but if life insurance is not important, and I say life insurance, whether life insurance or annuities or anything that insurance companies wrap, it's probably not a great home for you. I mean, just being candid, it really would not likely be a good fit. We are a specialist business. We are building complementary services, but at the end of the day, if you're an independent owner of a financial services firm, that insurance products are important to you, I think we're the best in the country. If you're not, there probably are other options. Just being candid. So let me get to my last point, which is the success formula looks like U squared plus 3C plus your ID. And then the last thing you have to do, I think you have to wrap this in your values. And I would ask you the question, do you think that values are a niche that you can compete on? I do. I think more than ever, it's an opportunity to compete on values. Because I think, and we're gonna hear later today from Ken Keyes and Anirban Basu, that I think what they're gonna talk about is this country is more polarized than it's ever been. I think what Mitch said is absolutely right, that people are looking for someone to take a stand on what it is that you're for, not what you don't like about this person, what you think's terrible about this country, but somebody to come through and say, this is what I can't talk about that. That's not important, all those things. Let me tell you what's important to us. Let me tell you what matters to us. And that is what we're trying to do at Valmark and why we put together the video that we did. So I would ask you these questions. I would say, do you genuinely believe that a niche can be about values? Not apologetically like, oh, we happen. I mean, lead with values, maybe, actually not even maybe, more than the other three components of that formula. And I would ask you, if you believe that, then what are yours? And are they kind of in your head or are they written down? I'm not going to pretend we've been great at this. Larry and I talked about we've always kind of had these values at Valmark, but we didn't write them down and make them official until almost 3 years ago. And I would say you should do the same. Are they celebrated? Are they rewarded? And are they a core part of your story? We are evolving. We are learning how to do this. We were much more of a technical business first, but becoming a business about not just building on the three-circle differentiation. We've been talking about three-circle differentiation for 2 decades, but talking about the unique identity of being a specialist firm. That's become more clear to us. I think it was always clear to Larry. I think it's become more clear to me. I think it's a better market. And I think more importantly than any of those things is the values that we've adopted and leading with those. And when we put together this video and these values, we worked with a consultant. He said, you do understand that some of the values you have are actually going to turn people off? And we said, yeah, that's kind of the point. That's kind of what values are for. We want to attract the people that fit. And we're okay if the people who don't think we're the bad people, that's okay. We're not trying to make everybody happy. So I would say, are they celebrated and rewarded? We've done that at Valmark. And I'm fortunate enough to say that Valmark was recognized as a top place to work in Northeast Ohio in 2020. And I think a lot of it had to do with values and not just writing them down, but actively rewarding and handing out core awards when people exhibit the core values and saying, if we don't do this in our own office, how in the world are our customers going to experience this core value? And the answer is it won't. So here is the final formula. I think the path to the future, look, this isn't bulletproof. I don't know if this fits for you, but I would say U squared plus 3C, leverage your differentiated markets. Don't apologize for being in the insurance business. Lead with it because everyone else wants to be like us. They can't figure it out. I'm telling you the truth. U squared plus 3C plus ID plus values, I believe, is a formula for success, the advisor of the future. And if you're more of a question person than a visual person, I would make those points with questions. I would say to you, is your value really built around coaching and advice? And if you think it is, then prove it with the materials, the pricing, the messaging. I would ask you, what services are you going to outsource? You got to have something. If you have nothing in that bucket, there's no chance that you're going to have U squared. I mean, you will be hiring people till the cows come home. Do you showcase your three-circle solutions? What fee-only advisors cannot? Are you a generalist or a specialist? It doesn't matter. Know your market and be clear on your messaging. And finally, what are your core values and do you lead with them? I'll leave you with the purpose statement for Valmark. You know, this was really Larry's story of his father and his dad of the golden rule, and then I had the privilege of coming up with this, of bringing the golden rule to life. And I mean both bringing it to life as in bringing it to the life insurance business, but also bringing it to life and making it real, making it actionable, making it reality. And to me, I'll end where I started this story, and that was I flew down here 15 years ago, scared out of my mind because I had no idea what I was doing. And you put your arms around me, and you exhibited the golden rule to me first. That gave me a lot of confidence to say, I want to work for these guys and these girls. And by God's grace, I've had the opportunity to have the role that I do now, and I still work for you. And trust me, there are still days that I feel like I'm going to throw up because I have no idea what I'm doing. But I would say to you, the golden rule starts here, and it starts with each other. So if you are sitting here thinking, I need help with all 4 or 3 or 2 or 1, or maybe I dominate all 4 of those, then find someone else who you can help do that. This is a mindset of abundance. This is a mindset of we all sharpen one another. This is the steel that sharpens steel, as we always say. And so what I want to share with you is don't be afraid to ask for help. Don't be afraid to admit you might not feel like I did 15 years ago with 5 days training and no idea what you're doing. But I think it's okay to say, I'm not 100% sure where my business is gonna go for the next decade. And I think I could use some help. Caleb, who would be a good firm for me to talk to about outsourcing? Who would be a good firm for me to talk to about how to really leverage all 3 circles? Who would be a good firm for me to really get into more of a niche market, to be a specialist? Who's done that effectively at Valmark? Or I'd really like to build and formalize values, and I want to lead with them, and I don't want to just put them up on the screen. I want them to be the primary differentiator. And that is what I'll close with Valmark has, is when firms come here and they ask me the question, well, why should I join Valmark? I never start with money. I never start with services. I always start with values. And I think that is what has created what we have today. And I think that is why I'm excited to partner with you to bring the golden rule to life. So thank you.